Welcome to Deep Dive into Finance and Investing channel. As we embark on this journey, we find ourselves at the heart of a fascinating subject: incentives in finance and investing. A fundamental force driving both financial markets and individual investment decisions, incentives have proven to be the invisible hand guiding the world of finance and investing. Their impact can be seen everywhere, from the boardroom to the trading floor, shaping strategies and influencing outcomes. Whether you're a seasoned investor or a finance enthusiast just starting out, understanding incentives is crucial. It can mean the difference between a successful investment and a costly mistake. So let's delve into the world of finance and investing and explore the role of incentives. Their influence is profound, their reach is wide, and their importance cannot be overstated. Stay tuned as we unravel the concept of incentives in finance and investing. To start with, incentives are essentially the driving force behind human behavior. They are the rewards or penalties that encourage certain actions or behaviors. In essence, incentives are about motivation, about making people want to do something. Let's think about this in a broader context before we zero in on finance and investing. In the real world, incentives could be anything. Maybe it's the prospect of a promotion that drives an employee to work overtime. Or perhaps it's the threat of a traffic ticket that keeps a driver from speeding. These are examples of incentives in action. Now, let's bring it back to our realm of interest: finance and investing. In this sphere, incentives often come in the form of monetary rewards. For example, a financial advisor might receive a commission for selling a certain product. This is a monetary incentive that could influence their behavior. But it's not just about money. Non-monetary incentives also play a big part. For instance, a trader might be motivated by the thrill of the game, the satisfaction of making a smart move in the market. The prestige of working in a high-stakes environment can also be a powerful incentive. There are also negative incentives in finance. Penalties for non-compliance, the threat of losing a job or a client, or even the fear of reputational damage can all serve as powerful disincentives, discouraging undesirable actions. Incentives can be explicit, like a bonus for reaching a certain target, or they can be implicit, like the expectation of a future promotion if a project is successful. Understanding these incentives is key to understanding behavior in the financial world. They can influence the decisions of everyone from individual investors to large corporations. They can shape the strategies of hedge funds and the policies of regulatory bodies. Incentives, therefore, play a crucial role in shaping the financial decisions of individuals and organizations. Now, how do incentives come into play in the world of finance? Let's dive into that. Incentives, in the simplest terms, are rewards or penalties that are offered to encourage certain behaviors. They're like the carrots and sticks that guide us through the maze of financial decisions. In finance, these incentives can take many forms: bonuses for reaching specific targets, penalties for poor performance, or even promotions for exceptional work. But why do they matter? Well, incentives can significantly influence our financial decisions and behaviors. They create a kind of psychological push and pull that can motivate us to act in certain ways. For instance, if a bank offers a high interest rate on a savings account, it incentivizes people to save more. Similarly, if a company offers a lucrative bonus to its sales team for hitting a particular target, it motivates the team to work harder and achieve that goal. Incentives aren't just about influencing individual behaviors, though. They also play a crucial role in shaping the broader financial landscape. For example, tax incentives can encourage businesses to invest in certain areas or sectors. Governments often use these incentives to stimulate economic growth or to promote social objectives, like renewable energy or affordable housing. Incentives can also motivate financial managers. If a fund manager's compensation is tied to the fund's performance, they're incentivized to make smart investment decisions that increase the fund's value. This alignment of interest between the manager and the investors can lead to better results for everyone involved. However, it's important to remember that incentives need to be carefully designed and managed. Poorly designed incentives can lead to unintended consequences. For example, if a sales team is only rewarded for the number of deals they close, they might be tempted to prioritize quantity over quality, which could ultimately harm the business. In conclusion, incentives play a critical role in finance. They influence our decisions, shape the broader financial landscape, and can motivate us to achieve better results. Clearly, incentives are a powerful tool in the financial world. Incentives also play a pivotal role in investing. Let's delve into how they shape the investment landscape. Imagine you're an investor. You're not just looking for a place to park your money. You're looking for the best possible return on your investment. Here's where incentives come into play. They can sway your decision, making certain investments more appealing than others. Let's take the example of tax incentives. Governments often use these to encourage investments in certain sectors. Suppose a government provides tax benefits for investing in renewable energy. As an investor, you're not just looking at the potential returns from the investment itself, you're also considering the additional benefit of the tax break. This can motivate you to take on more risk or to invest in this particular sector, even if you had not considered it before. Incentives can also come from the companies in which you invest. If a company offers dividends, it's essentially sharing a portion of its profits with its investors. This regular income is an incentive that can make the company's stocks more attractive. Moreover, incentives can also help navigate the risk-reward trade-off. High-risk investments usually offer the potential for higher returns, which can be a strong incentive for some investors. On the other hand, low-risk investments might offer lower returns, but the assurance of safety can be a compelling incentive for others. Incentives can also be psychological. The thrill of investing in a new, innovative startup, the desire to support businesses that align with your personal values, the satisfaction of seeing your investments grow. These are all powerful motivators that can influence investment decisions. So as you see, incentives are not just about monetary benefits. They're a complex mix of financial, strategic, and psychological factors. They can steer investors towards certain types of assets and influence their willingness to take on risk. Incentives, therefore, are integral to the investing process. The impact of incentives in finance and investing is far-reaching. They are the invisible hands that shape market trends, influence economic growth, and even impact social behavior. Incentives in their various forms can steer entire markets. They can create or bust investment bubbles, drive up stock prices, or trigger market corrections. When companies offer incentives such as dividends or stock buybacks, they attract investors. This increased demand can cause a surge in the company's stock price, influencing market trends. Similarly, government incentives such as tax breaks or subsidies can stimulate economic sectors, leading to increased investment and growth. But incentives aren't just about numbers and markets. They also have a profound impact on human behavior. People respond to incentives. Whether it's the promise of a higher return on an investment, a bonus at work, or a tax rebate, incentives can motivate people to take actions they might not otherwise consider. This is why incentives are such a crucial tool in finance and investing. They can encourage saving, promote responsible spending, and even stimulate economic growth by driving consumer demand. However, it's essential to remember that incentives can also have unintended consequences. If not designed and implemented carefully, they might lead to risky behavior, market instability, or economic inequality. For instance, excessive incentives might encourage reckless investment, leading to asset bubbles, or they might disproportionately benefit the wealthy, widening the wealth gap. So while incentives can be powerful tools, they must be used responsibly. Policymakers, financial institutions, and investors need to understand their potential impacts, both positive and negative, and design them with care. This understanding is crucial in harnessing the power of incentives to create a more prosperous and equitable financial landscape. In conclusion, incentives are more than just financial tools. They are catalysts that can transform economies, shape societies, and even influence individual behavior. They are the levers that can move the financial and economic world. Incentives, therefore, have a profound effect on our financial and economic landscape. In summary, incentives are a fundamental aspect of finance and investing. They are the driving force that fuels the financial world, sparking motivation and encouraging behaviors that align with the goals of investors and financial institutions. From our discussion, we've seen how incentives play a crucial role in finance, steering the direction of money flow and shaping the landscape of financial institutions. They serve as the compass that directs the actions of players in the financial market, and their impact cannot be overstated. In investing, incentives act as the guiding light for investors, helping them navigate the complex world of investment opportunities. They provide the stimulus needed to make informed decisions, balancing risk and reward in the pursuit of financial growth. The impact of incentives is far-reaching, affecting not just individual decisions, but shaping the entire financial ecosystem. Understanding incentives can help you make better financial and investment decisions. Thank you for joining us on this deep dive into finance and investing. We look forward to seeing you next time.